going to talk about cash secured puts and covered calls, a method that I actually use to create cash in my brokerage account. First off, you need to open up a brokerage account. You need to fund the account, and you need to change the account to trading options. Pros of this method that I use: returns can be high, can work with stocks that don't appreciate in value. It does create cash in your account, and you do not have to hold the stock for a long period of time. Therefore, it has reduced risks and it's very liquid. The cons of this method is that it requires a lot of cash, and there are no tax benefits since you're not holding the stock over a full year, and you can lose money. The anatomy of an option contract is that the option is a contract between two people to either buy or sell a stock at a certain price, which is the strike price, before an expiration date, and for a certain price paid for that contract called the premium. We have some examples down here. This is a call option for Ford. It expires February the 18th, 2012. The strike price is $11 and the premium is 53 cents. This is a put option for China Mobile. February the 18th is the expiration date, and the strike price is at $47.50 and the premium is at $1.50. You need to select a stock for this method that has a low price per share, around $10 to $20, and that fluctuates by about 10% up and down in price during a month or less. You want a stock that moves due to economic news. So here we have two stocks to look at. And of course, the one here that is slowly increasing in value, this is the stock's price per share, and this is the time over time. You're wanting a stock that actually fluctuates up and down. So let's say this is $11 and this is $10, or say this is $11 and then $10 and then back to 12, back to 10, then 11, and so forth. You just want one that stays within a trading range and doesn't move a lot either up or down. Okay, this diagram right here helps me understand which side of the option that I'm on. For example, a call option. If you buy a call option, you have the right to buy a stock before the expiration date. The person that's on the other side of that coin would be me. I like to sell call options, and I'll also like to sell put options. But the thing of it is that if the buyer of the call option exercises his right to buy the stock, then I am obligated to sell that stock to him. And then of course the same thing on the put side. The buyer of the put has the right to sell the stock, but the person that's on the other side of that, which would be me, if I'm a seller of a put option, then I'm obligated to buy that stock before the expiration date. When you are obligated to buy or obligated to sell a stock, that is called assigned. So if on expiration date for some reason the person of the call option decides to exercise his right to buy a stock, then I'm obligated to sell him that stock, and I'll have to have that stock in the portfolio. Same thing with a put option. The buyer of that put option, if he exercises the right to sell that stock that he has, I am obligated to buy that stock. Okay, this is the sequence that I use. First off, I will write a put option. What that means, I'm selling a put option. I'm obligated to buy a stock at expiration date if assigned. If I'm assigned to buy the stock, then I do so. That requires cash to be in the account so that you can actually buy the stock. Okay, if this does not occur, then the premium that you received as cash, you get to just keep that cash in your account. But let's say that you are assigned to buy the stock. Okay, I have the stock, it's in my portfolio. Now I would look and wait until there's a specific time where I would want to write a call option. That means I'm obligated to sell that stock that's been assigned to me. So then I write the call option, and then I wait until expiration date. If I'm assigned to sell the stock, then I have to sell the stock. I'm obligated to sell the stock, then I'm back to square one again and start the whole sequence over again. So in the upper left-hand corner, our very first thing that we're going to do is to sell a put option. We're going to wait for the price per share of the stock that we're watching to start falling. That is when we will sell or write a put option. That option will obligate us to buy that stock at a specific strike price. Now, you want to select the strike price that you are willing to buy the stock if the option contract is exercised and you are assigned the stock. So here we have an example. It was up real high, it started falling, and finally we get down to a certain point, and then we sell the put option. I use a spreadsheet to keep track of cash secured puts and covered calls that I make. One contract equals 100 shares. So if you have 14 contracts, you're going to be buying 1,400 shares of that stock. The strike price that I found for this stock was at $11. So 1,400 times 11 equals 15,400. It has an expiration date 39 days later. The premium that we have is $1.02. So for every contract, I'll get $102 for that contract. So the total amount that I will receive in cash is $1,428. The commission on that was $19.04. So I will net $1,408.96 at expiration date. So if we look at the return, if you take this number here, the net plus the basis, and you divide it by 15,400, you come up with the total return. You knock off the 1, it's actually 9% return in 39 days. That interest rate per day is this amount here, and if you extrapolate that over a full year, you will double your money. So getting $1,400 out of $15,400 is really high. So we buy that contract, and at expiration date, we're assigned that stock. We actually own that stock. Well, our break-even point will be $11 minus $1.02. Now, in our example, we have sold a put option, and at the time of expiration, in our example, we've assumed that the stock was assigned to us. So we were obligated to buy the stock. That only happens when the stock price is below the strike price. So at expiration date, if the strike price was at 11 and the actual stock was at 10.50, then the person that owns this contract has the right to sell the stock at $11, and they will do so. Then you're assigned that stock and you have to buy it at $11, even though it's at 10.50 at that time. So now we own the stock. Now let's look at this side. This is the second leg of our equation. We are going to sell a call option. You want to sell a call option when the price of the stock is rising. When that happens, the premium for that call option will rise when you're writing it. Again, on the second leg of the equation, you want to sell the call option. You're waiting for the price per share to be rising to sell or write a call option. You want to select a strike price that you're willing to sell the stock if the option contract is exercised, and you are obligated to sell the stock at that price. In our second leg now, we're going to wait for the price of the stock to start rising. When that happens, the premium will start to rise, and you're wanting to get the most out of the call option that you're actually selling. So here in my example, we had the same number of contracts, 14, which is 1,400 shares. I waited until the premium got up to a good amount. Now, once it goes above $11, the actual price of stock goes above $11, then the premium will actually go up higher too. And sometimes you can get up, if this went up to $12, then the premium will be much higher. We had a commission of $20.32, and then our net for the call option was $973. So if we're looking at that on a yearly basis, it was a 70% return. So we need to look at this 81 days that we have been working in using a cash secured put and a covered call. At the end of the whole sequence, in 81 days, we've had $15,400 in cash that has been at risk. Out of that $15,400, we've actually gained $2,382.64. We look at that as a return. In 81 days, we've had a 15% return, and if we extrapolate that out over a full year, you get a 91% return. So again, this is a good way to create cash in your account. Some things to consider about this method: it can create cash. It uses a stock that the price per shares is moving sideways. Again, the stock doesn't have to really appreciate in value a lot over time, nor does it need to depreciate in value. You want something that stays within a specific trading range, so you can decide when to write your puts and to write your call options. This method keeps you very liquid. Some other things to consider: you should look at option contracts that are 2 months or more in the future. The premiums for those option contracts are usually higher than contracts that are expiring less than a month. Some final notes: I'm not a financial advisor. This method is for trading purposes, not for investing. You need to do your own homework. I'm proposing what works for me, and use this information at your own risk. I hope this small little tutorial can help you and to give you more insight into option contracts.